Good morning, friends, and welcome to today's session on IndAS. I welcome the speaker and hand over to our moderator, Manilal Bhai. Manilal Bhai, all yours.
Good morning, friends. Today is our 10th session on IndAS series. Today we are having a lecture on IndAS 37, which is pertaining to provisions, contingent liabilities, and contingent assets, and IndAS 112, which is relating to interest in other enterprises. Both the sessions are going to be conducted by our today's learned speaker, Sri Bhaskar Iyer. Today is a 5th September. It is a special day. It's a Teacher's Day. Wishing a happy Teacher's Day to all the learned speakers who are part of the team and part of the viewers. Now I will give a brief introduction of today's speaker, C.A. Bhaskar Iyer. C.A. Bhaskar Iyer has a close to 20 years of experience in the industry in the field of finance, accounts, and audit. In his professional career, he has been associated with industry sectors like shipping and logistics. Currently working as a partner at Messrs. Talati and Talati LLP Chartered Accountants based in Mumbai. He is heading the statutory and internal audit services and advisory on the implementation of IndAS. He conducts the training programs of IndAS for clients as well as for CA firms and is also speaker on IndAS at the WIRC of ICAI. He has co-authored book on comprehensive guide to Indian GAAP based on the existing Indian GAAP, which is accounting standard, and IndAS, simplified with illustrations, extracts, and disclosures checklist. With this brief introduction, I hand over the session to Sri Bhaskar Iyer. Welcome, sir, for the session. Wish you happy learning to everyone.
Thank you, my Vijay Bhai. For this session, and I hope it has throughout. We start the actual event to discuss few impacts of the India's itself actually. Now when just existing possibly known as the Indian
voice is breaking, sir.
My not
Sir, your voice is breaking.
There seems to be some technical error. Just please hold on. Yeah. Yeah.
is it clear now?
Yes. A bit. Can you just be a bit louder? That's all.
Is it clear now?
Yeah.
Okay.
Yeah.
So sorry, I don't know why it happened actually. Yeah.
No.
Sir, before we actually go into this IndAS 37,
Yeah.
I want to discuss a few things about what is the importance of Indian accounting standards vis-a-vis the AS. Friend, we all know that the accounting standards, which is popularly known as the Indian GAAP, was drafted way back in 2006. Okay, and in on March 31st, 2016, some of the accounting standards were actually modified, and they were brought in line with IndAS, though not actually IndAS. So when we talk about IndAS, we need to first find out what is that that is so important and so different from AS. When I study this IndAS, and I've been studying this IndAS for last couple of years. So when you compare IndAS vis-a-vis the AS, I feel that there are three very important takeaways for the IndAS. Point number one: first of all, IndAS is very, very elaborate. It is exhaustive, and also it is very, very voluminous as compared to the accounting standards. Just to emphasize on this point, AS revenue is a 9-pager standard, whereas the same standard which deals with revenue, which is 115, is almost 100 pages. So, we can expect how voluminous it is in the IndAS. The second important aspect of IndAS, friends, when you compare it with AS, see, AS does not give us clarity on so many items which are recognized in the financial statements. Now, just to give a brief on such, which are those very critical standards where there is no proper guidance in AS, I will take up the following. First is IndAS. First is the revenue standards. When you look at the AS9 and compare it with the IndAS 115, AS9 does not give us any guidance relating to what happens when you have a bundled products. Matlab, when you sell multiple products under one contract arrangement. To give an example, suppose I am into a business of selling mobile. So I sell mobile as well as I sell the airtimes together as a single product. So there is no clarity given in AS as to how we should segregate both the different items, which are actually different types of services and different products, which requires a separate recognition. So there is no clarity or no guidance in AS9. The second important aspect of the IndAS is IndAS primarily talks about, the measuring the consideration received or receivable at a fair value. Most of the transactions which happens with third parties are always at the fair values, but this sometimes gets hampered, the fair value concept, when you deal with related parties. So IndAS, the premise of IndAS is fair value, whether it is assets or liabilities or incomes, it should be at a fair value. The third important concept of revenue is, in our accounting gap or the Indian gap, we don't have any guidance on how to, account for a service concession arrangement. Service concession arrangement, you all know, friends, where where is there is a with the grantor, which is probably the public enterprise or the government, and the operator, the person who is supposed to construct or maintain the facilities. So there is no such guidance in AS. And if you see the Indian accounting, how the people do the in the Indian accounting, people, whatever expenditure they incur for construction of, say, example, a toll road, so they capitalize it as an intangible asset and amortize over a period of the service concession arrangement. So, but in case of India, there are specific guidance because you cannot recognize a toll road as an intangible, because first of all, we don't have control over the toll road. That is not our property. So there are very specific guidances which are given in India. The second standard, which is very elaborate in India is, and which is actually more or practical, is the business combination standards. Friends, we all know that in AS we have the two standards which deal with the combinations, business combinations, namely the AS 14, which deals with accounting or amalgamations, and the AS 27, which deals with the consolidated financial statements. Now, friends, if you look at carefully the AS 14, what does AS 14 actually do? AS 14 only talks about combinations in case of an amalgamation. That is when two or three entities they join together and form a third entity. Or it talks of a business combination in the form of an absorption, where one company is being absorbed by the other, and the absorbed company no longer is into existence. So this is what is covered in AS 14. Again, about the control aspect, and very few things are covered in the in AS 27, which is the consolidated finance statements. No, friend, when you see IndAS, IndAS 103, IndAS 110, IndAS 111, which is joint arrangement, these are all very, very elaborate standards. And, these deal with all the types of business combinations. Now, again, when you talk of AS, what do we say? We don't, we, the consolidated finance statement standard is independent of its own. Whereas in case of IndAS, all those entities to whom IndAS 103 applies, they will have to adopt 110 also. So that is how it is interlinked in IndAS. And also, in case of AS, see, there is no concept of how to account for investment in an investment entity. So there is no clarity on that. Whereas in IndAS, there are specific pointers available for that also. Third important standard, which is I feel it is yet to be covered in this education series, is the financial instruments. No, financial instrument, friend, very briefly, we have this AS13, which talks about accounting for investments, where we have the investment which are either split into the current investments, or we have investment which are split into the non-current investments. Now, non-current investments, we have an option that it is always carried at cost, and we provide for diminution in case there is a permanent decline in the value. In case of the current investments, it is either the cost of the market value, whichever is lower. So there is very few guidance which is given in AS13, whereas case of IndAS 32 and IndAS 109, which deals with financial instruments. These are all a chapter in itself, and there are so many authors who have written books on these financial instruments only. So these are the great the vast differences between the existing accounting standard and IndAS. And the most important takeaway of the IndAS is, friends, as we all know that whether we are in industry on the accounts and finance job, or we are into auditing, doing the audit of various corporates, having a good knowledge of IndAS increases the opportunities for an individual, whether he is into the industry or whether he is into audit firm. It gives a massive opportunity for him for his growth also. So these are the very important aspects of IndAS. So IndAS, one, if anybody is into stat audit, I feel we should spend a lot of time devoting in IndAS, because this is going to be there for the next 5 to 10 years anyways. So this is of the basic background of IndAS. Now, friends, coming to what we are supposed to do today. I have been allotted two topics. One is IndAS 37, which deals with provisions, contingent liabilities, contingent assets. And the other is IndAS 112, which deals with disclosure of interest in other entities. No, friends, as far as the second topic is going, 112, disclosure of if interest in other entities. Friends, I would not like to elaborate much on the topic discussion on this topic, because this is purely a very theoretical topic, where see, how do you interest in other entities means what? It can either be a subsidiary, it can either be a joint venture, it can either be an associate, or it can be either investment in any unconsolidated structured entities. So it only deals with, suppose we have investments in or interest in other entities, what are the various types of disclosure which we need to make? And it is absolutely has got no technical things in that. It is a purely disclosure standard. Now, IndAS also has other disclosure standards, like maybe, IndAS 24, which deals with related party transactions, and also IndAS 108, which deals with operating segments. No, friends, even though these two are also disclosure standards, but there are quite a huge number of technical things we need to understand before we can, actually report or disclose on these particular standards in the financial statements. Example, in case of IndAS 24, it gives us the various concepts of what type of it gives us the various type of various types of related parties, how you identify related parties. Whereas in case of IndAS 108, the operating segments, it gives us how to identify a particular segment as an operating segment for reporting purposes. So there are certain technical aspects involved in those standards, but in 112, absolutely there are no technical things, and hence I would like, I have a presentation of a 5 to 7 sliders which I have already shared with the conveners, and maybe they will be able to provide it to you. Now let us concentrate in this session on the main topic, which is IndAS 37, that deals with provisions, contingent liabilities, and contingent aspects. No, friends, IndAS 37 is a standard which is not very difficult to understand. But friends, there are a lot of technical things involved in the standard, which we, either we are on the accounts and finance side in an industry, or we are the auditors, we tend to overlook these particular technical items. And these technical items actually deal with whether on a given balance sheet date we should be recognizing a liability or a provision, or we should be disclosing it as a contingent liability. So there are a lot of technical things involved in that which we tend to overlook. So my discussion today will cover all these thing aspects only. And my presentation and my discussion will be more, I have included a lot of examples in the discussions, which my request to all the participants is, let us not go into the technical aspects of the examples. Rather, we just read the example in its plain context form to understand the substance of identifying and recognizing items in the financial statements. So let us not go into more or more technical. These are only to bring out a point and bring out some clarity and how a particular items, whether provisions, contain liabilities or assets, should be disclosed or recognized. Now, coming to most important aspect now. So with this brief introduction, what IndAS 37, what I'm covering in this topic is, friends, first of all, I'll be covering about provisions. Provision means, what do you mean by provision? How is it different from other liabilities? How do you measure a provision? How do you recognize a provision? And what do you need to disclose the provision? Secondly, we'll also deal with some other aspects of provision where like onerous contracts, or maybe future operating losses and all these things, which are all supplementary or included part of these provision concepts actually. Then we'll discuss about contingent liabilities. We'll discuss about contingent assets. And there are also one or two appendix which is given in IndAS 37, which deals with certain decommissioning funds and certain levies. So we will briefly touch upon those also. So with this brief thing, friends, let us move into the now IndAS 37. Now, friends, what does IndAS 37 actually deal with? IndAS 37 deals with accounting for provisions, contingent liabilities, and contingent asset.
Please share
The,
your screen.
is visible now?
No.
I'm just wondering. How is that? Yeah.
Yes, now it's there.
Yeah. So, this standard deals with the accounting for provisions, contingent liabilities, and contingent assets. Now, the standard does not deal with provisions, contingent liabilities, and contingent assets from executory contracts unless they are onerous. Friends, we will discuss what executory contracts and what are onerous contracts in later slides. And it also does not deal with the accounting for liability which are covered by the other standards. Sir, how do you move the screen actually without actually? Okay. No.
It normally works at the
Yeah. ठीक है. Now, friends, these are some of the liabilities which are covered by the other standards. For example, in case of financial instruments like the financial guarantee contracts, they are covered by IndAS 109. Then lease liability, they are covered by 116. Contingent consideration acquired by the recognized by the acquirer, they are covered by 103. Employee benefits are covered by IndAS 19. Income taxes, they are covered by IndAS 12. Revenue on contract with customers, they are covered by 115. Now, friends, the most important aspect to note in all these things is the accounting for all these items are governed by the respective standards, but the recognition and measurement of these items will be governed by IndAS 37. So that you need to keep in mind. Though the accounting is covered by these standards, their recognition, when to recognize and how to measure it, these are governed by IndAS 37. Now, friends, before we actually go into the IndAS 37, see, we need to understand when a particular item is a provision or a liability, we need to first understand that a liability or provision is recognized only when there is certain obligation which is there on the balance sheet date. So before we understand the liabilities and provisions and contingent liabilities, we need to first ascertain whether on a balance sheet date I have any obligation. And an event which gives rise to an obligation is nothing but an obligating event. Now, what is an obligating event? The standard states that obligating event is an event that creates a legal or a constructive obligation and that results in the entity having no realistic alternative to settling that obligation. So on the balance sheet date, we need to first ascertain whether there are any events or any items which have occurred which will give me a liability in the future and which will give me an obligation to settle, and I have no realistic alternative other than settling the obligation. So this is an obligating event. No, again, the obligating event can either be through a legal obligation which is provided by the law, or through contractual arrangement, written or oral, for non-compliant statute example, etc. Or the obligating event can also be from a constructive obligation. Now, constructive obligation means, obligations which arises from the entity's past practices or published policies, and the other parties have reasonably certain that this obligation will be settled by the employee. Now, example, bonus, replacement of item during warranty period, etc. So these are all these are all which are established policies or practices of the entities. So this will be part of a constructive obligation. Now, a past event that leads to present obligation is called an obligating event. So this last sentence, please, one needs to have in mind that what is an obligating event. An obligating event, friends, let me reiterate that it is always has to be there on the balance sheet date for us to either recognize a liability or recognize the provision. Now, friends, though my topic is going to cover provisions, I first let us understand what is a liability first. Okay. So liability, to understand a liability, friends, what I have done is, I have taken up a small example. And, there is a very thin line of distinction between a liability and a provision. So let us look into the example. Plus, friends, just for 5 seconds, just go through the example and then I will take it up again. Now, if you look at the example, what does the example say? The example says that there is a company which is into business of manufacturing ready-made shirts. These shirts are sold by another company, company B, in the local markets. And the shirts are of different patterns and different sale prices. Now, A, under a contractual arrangement, is required to pay commission on the quantum of shirts sold by B. Now, there is a contractual arrangement which says A is required to pay commission only after the realization of proceeds from B. At a balance sheet date, B had sold 100,000 shirts. For shirts sold by B up to 31st of March, A received the sales proceeds on 30th of April. Now, the management feels that since we are required to pay commission, whether we should recognize the liability as at the balance sheet date. So, friends, just think over it for 5 seconds and then we will discuss it further. I hope you are all clear with what the actual example is all about. Okay. Friends, let us first go into the definition of a liability. The standard says that the liability is a present obligation which is based on a past event and settlement of which is expected to result in an outflow of resources embodying economic benefits. And for this, both the conditions need to be satisfied. Clear? So with the above example, let us see what the solution is actually. In the given case study, what is the obligating event for the company A? The obligating event, that is the event which gives rise to pay commission to company B, is receipt of sales proceeds. Whether there is present obligation on balance sheet date? No, because sales proceeds were received by company A were not received by the company A at balance sheet date. A is liable to pay commission only when it receives the sales proceeds. Whether the settlement is whether settlement is expected to result in outflow resource, and the answer is yes. Now conclusion, friends. When I am saying that on balance sheet date, I have no obligation to pay any commission. So there no liability exists at the balance sheet date, because the first condition, the present obligation based on a past event. Past event, the obligating event is the receipt of sale proceed. I have not received. So going by the data given the examples, company A should not recognize any liability on the balance sheet date because only one condition is satisfied. Clear about this, friends? Let us look at the what do you mean by provision now. Now, friends, in this example of provision, I have kept with the same case study, but I have made certain changes to the example. Now, the same thing, like company A is into the business of manufacturing ready-made shirts sold by company B, and company A is required to pay commission, which is based on a fixed percentage of the respective sale prices of the shirts. What I have removed, what the changes made is required to pay only after receipt of sale proceeds. So this condition is no longer there. Now there are two additional conditions. A finalizes its accounts by the 30th of April. The quantum of shirts sold and of each pattern is received by A on 15th of June. That is after the accounts have been finalized by and approved by the company A. Now whether company A should recognize the liability at a balance sheet date. Friends, are you clear about this example? It is slightly different from the first case study. Okay. Now here first let us understand what do you mean by provision. A provision is defined as a liability of uncertain timing and amount. Friends, most important item which you need to see, friends, whenever you are studying an accounting standard or an IndAS accounting standards, we always should give utmost importance to the definition part, because definitions will determine whether a particular item is covered by the standard or is not covered by the standard. So a provision is defined as a liability of uncertain timing and amount. So what does it mean? First of all, provision is a liability. So provision first has to meet the definition of a liability. The provision has to meet the recognition criteria for a liability. What is the recognition criteria for a liability? The recognition criteria means the three conditions should be satisfied. First, should be a present obligation based on a past event. Outflow of resources to settle the obligation must be probable, and a reliable estimate of the amount required to settle the obligation must be made. So when these things are satisfied, you will recognize a liability. So provision is nothing but a liability of uncertain timing and amount. Okay. In the given example, though A is entitled to pay commission to the company B based on the quantum of shirts sold, friends, you should look into the data given that as at 31st March and even at the date of finalizing the accounts or approving the accounts, A does not have the exact quantum of the shirts sold under each pattern. So what it should be doing? So it will lead to recognition of a liability where the amount is not certain. So let us look at the solution now. In the present case, what is the obligating event? Obligating event is the sale of shirts by company B. मतलब company B ने shirts बेचा, I am company A is liable to pay the commission. Whether there is a present obligation on balance sheet date, again the answer is yes to pay commission because B has already sold quantum of shirts as on balance sheet date. Whether the settlement is expected to result in outflow of resources, and the answer is yes. Whether the amount of commission is not a balance sheet date, and the answer is no. So what we should do, because it fits into the liability conditions which are required for recognizing a liability, but since the amount is uncertain, we need to recognize the provision based on the best estimate of amount that is required to settle the obligation. So did you find the differences between the two different type of examples given? Case one, case study one, and case study two, where in case of study case study one, there was no obligation on balance sheet date because the proceeds were not received. Whereas in this case study, the commission payment is not dependent on the receipt of the proceeds, sales proceeds. So this is the difference between the two examples which I have mentioned. So there is a very thin line of difference between what constitutes other liabilities and what constitutes a provision. The basic one thing we need to understand, friends, both are liabilities. However, where the timing of expenditure and amount required to settle the obligation is uncertain, it will give rise to a provision which claims or warranties. Where the timing of expenditure and amount required to settle the obligation is certain, it will lead to other liabilities with the trade payables. So clear about this thin line of difference between the liabilities and provisions? Fine. Now, once having understood provisions, let us go to when should I recognize the provision. This is called the recognition criteria for provision. Means it determines at what point of time the provisions need to be recognized in the financial statements. The provision should be recognized in the financial statements when and only when a entity has a present obligation based on a past event, which is called the obligating event. The outflow of resources embodying economic benefits to settle the obligation is probable. And when you talk of probable, the event is more likely than not to occur. Matlab, the probability of the event occurring is much higher than the probability of the event which is not occurring. And last but very important is a reliable estimate of the obligation, amount of obligation can be made. So when these three criteria are satisfied, then you need to recognize a provision in the books. So clear? So friends, I hope it is clear that what do you mean by other liabilities? What is that distinction between a liability and a provision? And what is the recognition criteria for a provision? I hope, friend, this is clear to you all. Now, let us take some other aspects of provisions also. It deals with future costs. Now, these are all, these are all various paragraphs which are given in the standard. But, I have developed examples. So, though, the meaning of what the paragraph actually states is will become more clearer. That is the reason I have put up all these examples. And, it will make the discussion also very interactive and interesting actually. Otherwise, all the Indian accounting standards are too boring to read. So let us look into the now what does this example say, friends? Now there is a company which is into the business of manufacturing chemicals. Friends, we all know that a company which is into the business of manufacturing chemicals, always there is some damage to the environment, and for that the company is always required to pay some penalties. And these costs are actually always based on some defined parameters. Now, a chemical company, the example state that the company is required to pay penalties or cost for unlawful environmental damages caused due to the production. These costs are certain defined parameters of chemical waste generated during the manufacturing process. However, as at the reporting date, that is the 31st of March, the company is yet to commence commercial production. However, the company feels that it is better to provide for these expenses as it is going to result in outflow resources. Now, whether this contention is correct, I hope, friends, you understand the example. You know that this company, as per the rules and regulation, they have to pay penalties. The company, as on 31st of March, is yet to commence this commercial production. However, the management feels that it is always better to provide for the expenses as it is always going to, and because the outflow of resources is going to be probable. So whether this contention is correct, I'll just give you 5 seconds to think over and then we'll discuss. Shall we discuss? Okay. Now, paragraph 18-19 of the standard says financial statement deal with the financial position at the end of the reporting period and not its possible position in the future. Liabilities are recognized are those that exist at the end of the reporting period. No provision is recognized for costs that need to be incurred in the future. So with this, what is the conclusion which can be drawn is, in this given case study, whether any environmental damages has taken place at balance sheet date, the answer is no, because the production has not yet started. The company will be liable to pay penalties only due to the chemical waste which is caused due to the production process. So as at balance sheet date, since the company has not commenced its production process, the question of paying penalties or any unlawful environmental damage does not arise. So there is no event is on balance sheet date. Whether there is a present obligation to pay cleanup costs or penalty at balance sheet date, and again the answer is no. So in this given case, no provision is to be recognized for cost that is to be incurred in the future. Friends, clear? Okay. Let us go to some other example. Now again, this is similar to the example which I have taken up earlier. Case study number 4. A company is in the business of manufacturing chemicals and processes leads to certain environmental damages. The government is proposing a new law for imposing penalties costs on company discharging chemical waste. As at the reporting date, the new law has not been enacted, but it is virtually certain that the draft law will be enacted. Whether there is any liability existing at the balance sheet date. Now just try to differentiate between this example and the previous example. In this, both the examples deal with a company which is into manufacturing chemicals. Okay, both the cases, the in the case study number 4, the company has not yet commenced commercial production. However, in case study number 4, the company has commenced commercial production. And in the present cases, the government is proposing a new law, but it is not yet enacted on balance sheet date. So just think over 5 seconds. Now, friends, let us go back to the answer now. Now, para 16 and 22 of the standard says, in considering whether a present obligation exists at balance sheet date, all available evidence, including, for example, the opinion of the experts and any additional evidence provided by events after the period, must be taken into account. In case where a proposed law is yet to be finalized, an obligation arises only when the law is virtually certain to be enacted as drafted, and such an obligation is treated as a legal obligation. So, in the given example, even though on balance sheet date, the government is just proposing a law which is not enacted, but it is virtually certain that the draft law will be enacted. So, there exists a present obligation on balance sheet date. Why? Because the production is in progress and chemical wastes are generated. At balance sheet date, whether virtually certain that the law will be enacted, the answer is yes, but the timing is not certain. Whether reliable estimate of amount required to settle the liability is possible, yes, because generally in case of when penalties are supposed to be implemented, it will be based on some parameters of production or something like that. So it is possible for us to estimate the amount of the uh, liability or outflow which will be required to settle the obligation. So what is the conclusion? The provision should be made for penalties or the cleanup cost based on estimates of amount that will be required to settle the obligation. So friends, are we clear on this? So future cost, when we talk of future cost, the standard says that future cost should not be recognized and the provision should only be recognized for those obligating events which are existing at the balance sheet date. Costs which are supposed to be incurred in the future should not be recognized as a provision. That is this. That is what the standard says. Now, in case, what is the difference between the case study 3 and 4 is there. There was nothing that the law was the law maybe the law was in force, but since the company did not start its chemical production, there was no question of generating any chemical waste. In the case study 4 is the law is yet to be enacted, but since it is virtually certain that the draft law will be enacted, we need to recognize the provision. So this is the difference between the case study 3 and 4. I hope friends you are all with you are all in sync with this and you are following the examples actually. Now friends, we have understood what we have so far studied over here is first of all what do you mean by liability, what is the provision, and we have also seen some examples on some future cost whether to be recognized as a provision or not. Now, after studying all these things, most important is how do you measure the provision now? Because since the amounts are not certain, so we need to have some methodology to estimate the amount of provision, which will again be the estimate of example, best estimate of amount which will be required to settle the obligations. So there is an estimation process involved. The standard says that there are two methods available for measuring a provision. First is the expected value method. First, what is the expected value method? The expected value method states when there are multiple outcomes, you know, when there are multiple outcomes, the best method is to attach probability to each of the outcomes and estimate the amount of provision. That is the expected value method. So expected value method involves a large population of items which they are assigned probabilities. Let us look into this example, friends. Now, a company sells goods to customer with a warranty cover of 6 months from the date of sale. The warranty coverage is for repairs to any manufacturing defects on the product sold. The cost of repairs are estimated to be rupees 2 lakhs in case of major defects, rupees 1 lakh in case of minor defects. And for the year, the company expects 70% of the goods to be sold having no defects, and 20% will have minor defects, and 5% will have major defects. So, what is the amount of provision to be made at the balance sheet date? So, friends, this is a case where I am into the business of selling products, and I have various different probabilities of outcomes. Either the goods will be sold with no defects, or the goods will have some minor defects, or the goods will have some major defects. So, in this case, how do we measure the amount of provision? Para 39 of the standard says where provision estimates involves large population of items, that is multiple outcomes. The estimated the obligation is estimated by weighing all possible outcomes by their associated probabilities. This method is called the expected value method. So in the present case study, there are multiple outcomes and the expected value of repairs is the percentage multiplied by the amount which will be required to settle the obligation. So 75% into nil, because this represents the goods sold we having no defects. 20% into rupees 1 lakh, which is having major defects, and 5% into 2 lakhs, which will have 5.2 lakh with major defects, and 21 lakh having minor defects. So the amount of repairs, that is the provision amount which one should make, is rupees 30,000. Clear about this, friends? Now this talks about there are multiple outcomes and probabilities which are attached to each outcome. The second method deals with the most likely outcome. How this method is different from the first method? The answer to this is, in this there is only one outcome. It is either a success or a failure. And if it is a failure, it will give the amounts, the best possible estimates of amount which will be required to settle the obligation. So out of a given outcome, which is the most likely outcome? Clear? The example will be make it more clear to you. A company suffered a serious breakdown to one of its manufacturing plants. The company had to appoint a technical engineer to repair the breakdown. The cost to be incurred for the repairs is based on man hours required to repair the machine. The repair cost estimated by the company are for 24 man hours rupees 5 lakhs, 36 man hours rupees 6 lakhs, and if it takes 48 man hours it is rupees 8 lakhs. So what is the amount of provision the company should be making at the reporting date? So clear, understood the example, friends? Here the outcome is that the company will have to incur repair cost. The outcome is only one, but there are different amounts based on the expected number of man hours required to repair the machine. What does the standard say? Where a single outcome is being measured, the most likely outcome may be the best estimate of the amount which is required to settle the obligation or best estimate of the liability. This method is called the most likely outcome method. Where other outcomes are either mostly higher or lower than the most likely outcome, the estimate will be either a higher or a lower amount. This is what the standard says. So let us look what the example will be. In the present case, using the most likely outcome method, the estimated cost of repairs, that is the provision amount, is rupees 5 lakhs. But a provision for a higher amount is made if there is a significant chance that more man hours might be necessary to repair the breakdown. So these are the two different methods which are available for measuring the provisions. And one is the expected value method, where there are multiple outcomes and there are probabilities attached to each outcome. And the most likely outcome means there is only one outcome, but the liability will differ, amount required to settle the obligation will differ based on certain parameters. So clear about this, friends, about these two methods? Friends, am I going too fast, or is it easy to understand, friends? Hello? Vijay bhai, is it okay? Hello, Vijay bhai?
Sir, it is okay.
It's okay? Okay,
Yeah.
thanks. So friends, up to here, what have we studied over here? Let us just, try to just refresh our minds. Here we have studied up to this stage, we have studied what do you mean by liability. We have understood what do you mean by a provision. What is the difference between a liability and a provision? How do you measure a provision? And which are what is the timing of recognition of provision? And we also understood, whether future operating cost or future cost should be included, should be considered for measuring a provision or not. So this is what we have covered right up to this stage. And I hope, and let us now move ahead for certain other areas also. Now, there are certain important aspects which we need to understand when we measure the provisions. These are called the measurement principles. The provision recognized should be the best estimate of expenditure which is required to settle the present obligation at the balance sheet date. Second, the provision is always measured before tax. So please, when you measure a provision, don't apply the tax rate. It should not be net of tax, it should be always before tax. Third, because here we are not dealing with deferred tax, we are dealing with provisions. Third, where the effect of time value of money is material, the provision shall be the present value of expenditures required to settle the obligations. increase in the carrying amount of provision with the passage of time is the borrowing cost. I will just little bit explain to you what does this mean. Now, friends, you must have done the property, plant and equipment, right? In property, plant and equipment, you must have studied about the dismantling cost or the decommissioning liabilities. Okay. Now, what? Just to give an example. Now, suppose I have say plant and machinery. The useful life is say 10 years, and I am going to, after 10 years I need to dismantle this plant and machinery. So there will be certain type of a dismantling cost or obligations which I will need to be incurred after the at the end of the 10th year. Now, the property, plant and equipment standard says that we need to recognize this dismantling cost in the books on the initial recognition date of the property, plant and equipment. So suppose the cost of dismantling, say after 10 years, yes, is estimated to be say rupees 10 lakhs. You apply a discounting rate and arrive at the present value of the dismantling cost as at the date of the recognition of the property, plant and equipment. Suppose this comes to say around say 7 lakhs. So present value of dismantling cost is 7 lakhs. The future estimated amount at the end of the useful life of the asset is 10 lakhs. So this 3 lakhs represent nothing but an unwinding of discount. Unwinding of discount is also referred to as a finance and represented under the finance cost. So every year you start your when you do financial instrument fund, you will be more familiar with what do you mean by amortized cost, because where you start with 7 lakhs, add interest, less payments, closing balance. So ultimately when you add up the interest year on year, you will arrive at the figure of 10 lakhs at the end of the 10th year. So this is called the unwinding of discount, and unwinding of discount is always recognized as a borrowing cost in the profit and loss. Third feature is the future events that might affect our estimating the amount of expenditure to settle the obligation is included in the calculation of provision if there is supportive evidence that they will occur. For example, in estimating cleanup cost reduction due to introduction of a new technology in the future can be considered. And last measurement principle for a provision is gains from expected disposal of assets shall not be taken into consideration in estimating the amount of provision. For example, in estimating the provisions for dismantling costs, disposal of assets are not to be considered in measuring the amount of provisions. So these are certain measurement principles which you should take into, or you should consider or keep in mind when you are measuring a provision. Reimbursement. Friends, sometimes it may happen that example in case of say warranties. Okay, it is quite possible that I am being the manufacturer of particular item, I am liable to pay the warranties, but some amount of warranties is reimbursed to me by a third party. So this is called a reimbursement. So what the standard says is where amounts required to settle the expenditure is reimbursed in part or in full by another party, the reimbursement shall be recognized when and only when it is virtually certain that reimbursement will be received if the entity settles the obligation. Clear? So reimbursement agar hoga in future, whatever liability I'm going to incur, and if I'm entitled to certain reimbursement, the reimbursement should be recognized only when it is virtually certain, or there is, and virtual certainty means there always is a contractual to that agreement to that effect. Otherwise virtual certainty is very difficult, because based on the past practice and all, the virtual certainty clause is never fulfilled. So there has to be some specific document on hand that I am virtually certain to receive this reimbursement. Reimbursement is treated as a separate asset. It shall not exceed the amount of provision. In the statement of profit and loss, the expense relating to the provision may be presented either net of the amount recognized for the reimbursement. So this is what about a small the paras on reimbursement when you measure a provision. Then the provision shall be reviewed at the end of each reporting period. Provision shall be reversed when it is no longer probable that an outflow of resources will be required to settle the obligation. Clear about this, friends, about the provisions? So, just to refresh, provision is a liability of an uncertain timing and an amount. Provision should always be measured before tax. Provisions should always be the best estimate of the amount which is required to settle the obligations. The provisions should be discounted to its present value, where the time value of the money is very significant, and reimbursement should be considered in measuring the provisions only when it is virtually certain that an event will occur which will result in me, the entity, getting the reimbursements. So these are some of the very important principles which you need to consider when you are measuring a provision. Clear about this, friends? Shall we take a break for around say for 3 minutes?
Okay, sir.
Huh? Yeah.
No
Okay.
problem.
So we'll meet in 3 minutes again. Vijay, the session is okay. People are following the session actually.
Yes, yes, sir.
Okay. Thank you.
Yes, start. मणिलाल जी वो क्वेरी पूछ लीजिए, then we proceed.
Yeah, please.
मणिलाल जी,
उनका म्यूट है, मनीला जी को ओपन म्यूट अनम्यूट करना पड़ेगा.
मैं ही रीड कर लेता हूँ. Whether a party who incurred an expenditure related to an asset against which the payment is yet to be made is required to recognize the provision liability where the asset is not recognized in the books.
Actually, the question is not very clear. What does the मतलब are we going to incur?
He
समझाने में
said,
क्वेश्चन रहेगी.
he says the expenditure is incurred, यानी एक किस्म से डील हो गया होगा
हाँ हाँ
for buying the asset,
हाँ
but
हाँ.
the payment is also pending and that asset is not recognized in the books, means some asset is purchased but it is not recognized in the books.
Okay.
Yeah, so whether we have to incur the liability for
Sir, actually the standard very clearly states ना कि whether there is any obligation on part of me at the balance sheet date. Okay.
yeah.
अगर मेरे को obligation है on the balance sheet date that there will be outflow of resources. Now, if it is for any future cost, तो उसका कुछ करना नहीं अपने को तो. Okay. But if it is expenditure or the liability is existing at a balance sheet date. So actually ये जो क्वेश्चन लोग ने फ्रेम किया ना सर, दिस इज एक्चुअली नॉट प्रॉपरली फ्रेम्ड बाय द पर्टिकुलर पर्सन एक्चुअली, कि एक्सपेंडिचर अगर मेरा पास ऑब्लिगेशन इज देयर ऑन बैलेंस शीट डेट, आई हैव टू मेक अ प्रोविजन ऑफ द बेस्ट एस्टिमेट, बट इफ आई एम नॉट ऑब्लाइज्ड ऑन बैलेंस शीट डेट, आई डोंट हैव टू मेक अ प्रोविजन.
Okay. ठीक है सर, you can proceed now.
Yeah. Welcome back, friends. We will look into one more aspects of provisions, that is future operating losses. The standard gives guidance about whether or not to recognize future operating losses, and this I will emphasize with the example, with the help of this example. Case study number 7. A manufacturing company suffered a serious breakdown to one of its manufacturing plants at balance sheet date. The machinery repairs is estimated to take 3 months, during which the company is expected to have an operating loss of rupees 5 lakhs. Whether this loss can be recognized in preparing the financial statement for the current period. I hope the question is quite simple. That balance sheet day के दिन में machinery breakdown हो गया, and due to which the company is expected that it will suffer an operating losses in the next 3 months up to rupees 5 lakhs. So with the March ka, when I'm preparing the balance sheet, whether I need to consider this loss in preparing the financial statements. This is the question. Now, para 63 and 65 of the standard says provisions shall not be recognized for future operating losses. Future operating losses do not meet the definition of a liability and recognition criteria for provisions. So, what is, just to refresh everybody's mind, what is the definition of a liability? Definition of a liability is a present obligation based on a past event and outflow of resources embodying economic benefits is probable. What is the recognition criteria for provisions? Again, present obligation based on a past event and outflow of resources is probable and reliable estimate can be made. And however, the standard also states that impairment testing of the assets of the operation may have to be made as per the IndAS 36. So this is what the standard says. So what is the conclusion of this example? In the present case study, whether there is any liability as the balance sheet date, answer is no. Conclusion is no provision for impairment losses needs to be recognized in the financial statements. However, an impairment testing may be required to the main manufacturer in accordance with the IndAS 36. So no provision for any operating losses should be made. I am sorry, this word to be changed. No provision for operating losses should be made in the financial statements. Clear about this, friends? Now, friends, when we just started the topic, we discussed an item of, say, provisions. The standard does not cover accounting for provisions, contingent liabilities, contingent assets in case of executory contracts unless the contracts are onerous. So basis that, this example is linked to that particular statement. Let us go to the example, friends. A real estate construction company entered into a contract with another company to construct residential houses. Due to the COVID pandemic and significant slowdown in the economic activity, the project has become no longer viable. If the company completes the project, it will have to incur irrevocable, recoverable additional cost of rupees 20 lakhs. Or if it wants to exit the project, then it will have to pay the other company rupees 10 lakhs as penalties. Whether any provision is required to be made since the contracts are still executory in nature. So understood, friends? So this is a case where the construction, the project is still in the executory stage. Okay, and in the executory stage, whether any provision for losses is required to be made or not. So this is what deals with this. This topic deals with this aspect. Let us look into what the standard says now. Para 69 and 66 to 60 of the standard says deals with onerous contracts. Executory contracts are those where both the parties to the contract are still to perform their respective obligations. Onerous contracts are those where unavoidable costs of meeting the contract obligations exceed the economic benefits expected to be received under it. Though executory contracts are not accounted for under IndAS 37, if, however, the contract is onerous, the present obligation under the contract shall be measured and recognized as a provision. Clear about this, friends? So, onerous contracts, if the contract is executory, you need not make any provision. However, if the executory contract has an onerous element, that is the costs which are required to complete the fulfill costs required to fulfill the contract exceeds the economic benefits which are going to be derived, then this amount will have to be recognized as a provision. Measurement of provision in case of the executory contract which has an onerous element are, it is measured at lower of cost of fulfilling the contract and any compensation or penalties arising from failure to fulfill it. Where any assets are dedicated to the contract, an entity recognizes impairment losses as per IndAS 36 that has occurred on the assets dedicated to that contract. So what the solution is? In the given case study, the contract between construction company and the other company are executory in nature, but it has an onerous element. Hence, the standard requires a recognition of loss in case of onerous contracts. Conclusion is rupees 10 lakhs should be recognized as the amount of provision that is lower of cost to complete the contract, that is 20 lakhs, and penalty for exiting the contract, that is 10 lakhs. Understood, friends? What do you mean by an executory contract and what is an onerous element in a contract? So this is how, if a contract is executory, you need not recognize any provisions. But if the executory contract has any onerous element, that is, we are forcing that the uh, benefits received from the completion of the contract is much lower than the cost which will be liable, which will be required to fulfill the contract, then we need to make a provision at lower of costs which are required to fulfill the contract, or penalties etc which are required for exiting from the contract. So this is the way you have to measure a provision. So, friends, with all this discussion, I hope, when I have started this session, I said that even though provisions, contingent liabilities, and contingent assets are quite easy standards, but there are a lot of technical things involved in that, friends. You know, and these technical things need to be kept in mind before we recognize any liability or provision in the financial statements. Because the moment you recognize a liability or a provision, it actually emphasizes that the company has recognized an obligation to pay in the books. So just creating a liability, or see, when we do practice as an auditor, or when we work as a as an accounts in the department, finance and account department, we don't give much emphasis to these technical aspects when we recognize a liability. Recognition of any amount as a liability or provision results in that the company will have to settle the obligation. So we need to be very clear whether there is any obligation at balance sheet date, whether outflow of resources is probable, and at the same time a reliable estimate can be made of that obligation. So only when these three things are, we should actually either make a provision or a liability in the books of accounts. Another aspect which is covered by the standard is restructuring. Now, the standard states that restructuring is a program that is planned and controlled by the management and materially changes either the scope of business undertaken by the entity and the manner in which that business is conducted. Examples of restructuring can be sale or termination of a line of business, closure or relocation of business or inter or intra within inter or intra countries, changes in management structure within an entity, fundamental reorganization that have a material effect on the nature and the focus of entities operations. So restructuring programs, generally, where you find restructuring programs, when a company has a multiple divisions, and it either transfers one of its divisions to other entities. So this is one of a restructuring program. Now, recognition criteria means when to recognize the provisions for a restructuring cost. Criteria for recognition of a provision is met. So friends, again, if you see the restructuring cost, we need to first go back whether the recognition criteria for provision is met. Again, just to refresh, I would like to say again, what is the recognition criteria for provision? It is a present obligation based on a past event. Matlab that obligation is existing as at balance sheet date. Second, the outflow of resources to settle the obligation is probable. And third, a reliable estimate of the amount required to settle the obligations can be made. So these are the three recognition criteria for a provision. So first, for recognizing restructuring cost, the recognition criteria for provision has to be met. And a constructive obligation to restructuring arises when the entity has a detailed formal plan for restructuring and it has raised a valid expectation in those affected that it will carry out the restructuring by starting to implement that plan or announcing its main features to those affected by the plan. So restructuring provision का तीन conditions है, but provision for restructuring cost, there are two conditions. One is the recognition of provisions has to be met, that those conditions have to be met. And secondly, a constructive, I can recognize provision for restructuring only either when the entity has a detailed formal plan for restructuring, and at the same time it has already communicated the plan to those who will be affected by the restructuring plan, or it has started to implement the restructuring plan. So provision for restructuring costs should be recognized in the financial statements at balance sheet date when the provision it satisfies the criteria for the recognition of a provision. And second, there is a formal detailed plan, and the company has either started to implement the plan, or it has already communicated its intention of implementing the plan to those who are affected by the restructuring program. Clear about this, friends? So let us go into examples now. The company decided to terminate a particular product of its business and sell off under a restructuring plan. The business to restructure is taken at a meeting of the board of directors before the balance sheet date, which is 31st of March. Whether the company should make a provision for the restructuring cost in the financial statements. Also, what would be your response in case the company discloses restructuring plans to those affected or implement the restructuring process after the balance sheet date? So friends, this is a case study on the restructuring, whether it is to be recognized in the books or not on balance sheet date. And there is a corollary question to that. What happens if the restructuring plan is implemented or disclosed to those affected after the balance sheet date? Just think for 5 seconds and we will discuss. Para 75 of the standard says the management or board decision to restructure taken before the end of the reporting period gives rise to a constructive obligation, does not give rise to a constructive obligation unless the entity has before the end of the reporting period started to implement the restructuring plan or announce the main features of the plan to those affected in a specific manner, which will also raise a valid expectation that the entity will carry out the restructuring. Also, where an entity starts to implement a restructuring plan only after the reporting period, reporting date, disclosure is required under IndAS 1, IndAS 10 if the restructuring is material. So clear with the what does the paragraph say? So paragraph states where in the given case study the decision to restructure is taken at the board meeting before 31st of March. The constructive obligation for restructuring arises only when the plan is either implemented or announce the main features of the plan to those affected before the reporting date. So the answer is whether the company has commenced implementation of the restructuring plan on balance sheet date. Answer is no. Whether the restructuring plan has been communicated to those affected employees before the balance sheet date. Answer is no. So the conclusion we can draw from this particular case study is no provision for restructuring costs to be recognized in the financial statement as at the balance sheet date, that is the 31st of March. So as I mentioned, provision for restructuring costs can be recognized only when the company has formally started to implement the plan and it has communicated to those that it will implement the plan who will be affected by the restructuring. Clear about? Now coming to the next question, what happens if the restructuring program is communicated to the people who are affected by the restructuring after the balance sheet date? The standard says where the company discloses the restructuring plan to those affected or implements the restructuring process after the balance sheet date, disclose in the financial statement if the costs are material. So this example deals with whether I should be recognizing a restructuring cost for restructuring as a provision or not at balance sheet date. So this example deals with that example. Now, let us take up an example of what type of costs which we can consider in the restructuring. Suppose the restructuring program has been taken before the balance sheet date. It has been either implemented before the balance sheet date, or it must have been communicated to those who must be affected by the restructuring program. So in those cases, provision for restructuring has to be made. But what are the items which we need to consider in making a provision or making estimate of cost that will be required for a restructuring program? So this case study will clear out those that particular aspect. The case study 10. The company having 3 divisions decides to sell off one of its divisions under a restructuring program. The divisions are located at different districts. The board has decided that it will retain certain employees and absorb them in other divisions and lay off certain other employees. As part of the restructuring program, the company has estimated the following costs. A. Costs which are directly associated with the sale of the business, rupees 50 lakhs. B. Termination salaries to staff laid off, rupees 10 lakhs. Cost for relocating retained staff at other locations and training of the staff, rupees 20 lakhs. Cost for increased facilities requirement at other divisions with the new systems, creation of office spaces, etc. due to relocation of the retained staff, rupees 15 lakhs. Now with these costs given, what is the amount of provision for restructuring costs required at the end of the reporting period? So friends, this case study deals with the cost which we need to consider in estimating the provision for restructuring cost. Now, what does the standard says? The standard says restructuring provisions shall include only direct expenditures associated with the restructuring program and not associated with any ongoing activities of the entity. Restructuring costs do not include costs such as retraining or relocating continuing staff, marketing cost, investment in new systems or distribution networks, because these are relate to the future conduct of the business and are not liabilities for restructuring at the end of the reporting period. So in line with our example, A, provision for restructuring cost is equal to rupees 60 lakhs. That is cost directly associated with the sale of business, that is a restructuring program, and rupees 50 lakhs, and the termination salary is rupees 10 lakhs. Costs which are not included in provision for restructuring cost is equal to rupees 35 lakhs. And what does it comprise of? Relocating staff, rupees 20 lakhs, and increased facility requirement, rupees 15 lakhs. They should be expensed out or capitalized as and when incurred. So I hope friends, with this example, one is quite clear of what are the items which we need to consider in making a provision for the restructuring cost. Just to refresh the minds, the cost should relate to all those costs which are directly attributable to the restructuring, and should not include any retraining or relocating staff. It should not include marketing costs. It should not include any investment, any new systems or distribution networks. So costs which are directly associated with the restructuring program should be included in estimating the amount of provisions. Clear about this, friends? Now, in line with again restructuring, let us consider one more case study. Continuing with the case study as given in 10 above. On sale of its division, the company will also be required to dispose of certain machinery associated with the division on which it is estimated to gain rupees 5 lakhs on disposal of the same. Whether this gain can be considered in arriving at the provision for restructuring cost. Friends, I hope this example is quite clear. Suppose I am selling divisions, so I am also selling some of its plant and machinery. And on selling the plant and machinery, the company is expecting a gain of rupees 5 lakhs. So, in making a provision for restructuring, whether we can deduct this amount of 5 lakhs. So, let us look at the answers. Para 83 of the standards is gains from expected disposal of assets are not taken into account in measuring an amount of provision, restructuring provision. Hence, in the given case study, the estimated gains on disposal of machinery of rupees 5 lakhs should not be considered in the amounts to be recognized as a provision for restructuring cost. So, friends, with all the discussions up to this stage, I hope it is, though this standard is quite easy to, to understand, but there are quite a number of technical things which are part of this, standard, and we need to consider it very carefully when we make any provision or create any liability in the books. So these technical aspects are very, very important in estimating what is that amount which will be required to settle the obligation in future. Clear about this? So up to here, what we have done is we have understood liabilities and we have understood what is the provision. So our discussion on provisions is ending over here. Going forward, now we are going to understand what do you mean by contingent liability and what do you mean by contingent asset. And again, we will have some appendix also, and we have some case studies at the end also. So up to here, anybody has got any query of understanding any particular aspect of whatever we occurred, either you can share it with the conveners, or or you can also, I have requested the convener if you can also put it to me on a mail, where I'll be very happy to reply to each of your queries. Let us move forward and let us now try to understand what is the contingent liability now. Now, friends, so basically, as I have always mentioned, to recognize a liability or to recognize a provision, there has to be an obligating event. So, existence of an obligating event on balance sheet date is of paramount importance for either its recognition or disclosure in the financial statements. Let us go to first example, where there is a present obligation based on a past event, outflow of resources required to settle the obligation, and amount and timing of the payment is certain. It will give rise to a liability which you have to recognize. There is a present obligation based on a past event. There is an outflow of resources required to settle the obligation. However, it is related, the timing and the amount is uncertain. So what do? It is a provision and you recognize a provision. Now, third important aspect. Now, this is where we talk about the contingent liability. What does the contingent liability say, friends? It is saying that there is a possible obligation based on a past event. A possible obligation, not a present obligation. It is a possible obligation based on past event, and the obligation is based on occurrence or non-occurrence of uncertain future events. Okay, so this obligation is not, it is a possible obligation which is based on future events, or there is a present obligation based on a past event, if you refer to definition of liability and a provision, but either outflow of resources is not probable or the amount of obligation cannot be measured reliably. So in this case, there is a contingent liability, and contingent liability is never recognized. It is always disclosed in the financial statements. So clear about this. The reason for me putting up all the things together is just to make you all understand what is the difference between these three things actually. So contingent liability कभी करेंगे आप? First of all, there is a possible obligation which is based on future events. Okay, so आप contingent liability disclose करना. Secondly, it is a present obligation based on a past event, which is similar to liability and a provision, but the outflow of resources is not probable. Okay, I am not sure whether I have to incur the whether there will be outflow resources, or amount of obligation cannot be measured reliably. No, friends, the classic example or classic case which fits into contingent liability is any demand notice which is received from the department. It, though there is a present obligation based on a past event, outflow resources, either it is not probable, or amount of obligation cannot be measured, or it is a possible obligation. So it can fall in any of these categories. So generally, any demand which we receive from the department and we are disputing, we always show it as a contingent liability, because we are not certain whether we need to pay that, or whether or we are not able to either estimate what amount which will be required to pay. So because of that, we don't recognize the provision, because friends, on the basis of a demand notice from a department, if you make a provision, it is nothing but you are acknowledging the fact that there is a liability in my books. So one needs to be very careful before recognizing a provision or liability, because it also leads to an acknowledgement that yes, I am liable to this amount. Clear about this, friends? So contingent liability, other aspects. Where the possibility of outflow of resources is remote, no disclosure is also required. ठीक है ना? Previous slide देखा आपने? What does the previous slide say? Is not probable to disclose. But अगर मैं बोलूँ कि if it is remote, possibility of outflows is remote, is not even probable, then I don't even need to disclose the contingent liability. Now, what happens where an entity is jointly and severally liable for an obligation? Quite possible, na? कि there may be an obligation where two or more entities are jointly and severally liable. उसमें क्या करना चाहिए? You recognize provision for the part of obligation for which an outflow of resources is probable, except in case where reliable estimate is not possible, and recognize a contingent liability for part of the obligation expected to be met by other parties. So this is a possible obligation where if they don't meet the liability, maybe you may have to step into the shoes of a liable of a creditor. So of a debtor. Sorry. So in that case, you disclose a contingent liability. So this is the what the paragraphs about contingent liability states. Contingent liability is always continuously assessed. Provision is recognized if the outflow of resources embodying economic benefit become probable. So as I have said, in case of any present obligation based on a past event, but the outflow is not probable, you disclose a contingent liability. But if you feel that outflow becomes probable, then move it from disclosing a contingent liability to recognizing a provision. This is what the standards is. So clear about this, friends? Now comes to the contingent asset. A contingent asset is a possible asset that arises from past events and whose existence will be confirmed only by the occurrence or non-occurrence of one or more future events. Let us look at the case study. Friends, when we all, in our profession as either the accounts and finance people or the auditors, when we do an audit or when we are the accountants, you see, we come across certain, claims made by the company. Okay. And, management feels that, nahi, ye claim to mil jayega, so we should recognize the claims. So this particular contingent asset topic deals with those particular items. When at what point of time should we disclose or recognize any contingent asset in the books? Let us look at the example now. Case study number 12. A company has made a compensation claim against a government entity and the matter is pending before the High Court. As at balance sheet date, based on the hearings in the case, the lawyers representing the company felt that the case will be in their favor, and according the company recognized income with the corresponding debit to the asset account, that is the receivables. Whether this is correct? Friends, in our day-to-day working or as an auditor accountant, we also come across certain insurance claims. So many people, many companies, and lot of instances I have seen where people recognize the insurance claims. So this aspect deals with that. Para 33, 34, and 35 of the standard says contingent assets are never recognized in the financial statements. So management आपको बोलेगा recognize करो तो भी बिल्कुल we should not recognize as auditors contingent assets. Where the inflow of benefits is virtually certain, the asset and the related income are recognized in the financial statements of the period in which the change occurs. Disclose contingent asset where the inflow of economic benefit is probable. Clear about this, friends? The तीनों sentences are very important. Contingent assets never recognize. Recognize means you should never create an asset in the financial statements. Where the inflow of economic benefit is virtually certain, it is backed by hardcore document that I am going to receive this amount, and then only the related income should be recognized. And where the contingent asset inflow of benefits is probable, like in the given example where the lawyer feels that the case will be in their favor, disclose a contingent asset but never recognize. So what does the conclusion say? Whether the receipt of claim is virtually certain, no, there is no court order to that effect. So conclusion is no income should be recognized based on lawyer's advice. Only when the inflow becomes virtually certain, that is backed by a court order, company should recognize the income and the related asset. Friends, we should be very careful, and I have seen in lot of when I'm doing the audit of so many, I have seen quite a number of companies recognizing contingent recognize assets which are in the nature of contingent assets. So we should be very clear about this. you know Example, the classic example is insurance claims. People just recognize, in one of my companies where I was the auditor, there was an arbitration claim, a matter which was referred to arbitration between the company and the government authorities. And the company basis the progress of the hearings, they recognize an income which is nothing but a contingent asset, because there is no hardcore order received from the arbitration authorities. So you can never recognize such contingent asset in the books. So we need to be very careful, and we should be clear about this, what is a contingent asset or whether it is converted into an income for its recognition. Clear about this? So friends, we know with this thing we are coming to almost the end of understanding provisions, contingent liabilities, and contingent assets. So friends, I just to conclude again, though we have more case studies coming up at a later slides, I just wanted to the standard, though it is very easy to understand, there are a lot of technical things in that, and we need to be very careful before we think of any recognizing any asset or liability in the books, or whether even we think of disclosing something in the books. So standard lays down certain parameters for disclosure and recognition, and we need to be careful about that. Clear? Let us move ahead. See, there is one more. There are two appendix which are given to the standard funds. One is appendix A, rights to interest arising from a decommissioning, restoration, and environment rehabilitation funds. Now, frankly, I don't know how relevant, and at least in my audits, I have never seen creation of these type of rehabilitation funds. So, what does this actually appendix? Just to give a very brief idea of what this appendix is. First of all, it says it talks about setting up of certain decommissioning, restoration, and environmental rehabilitation funds. Secondly, it talks about there being either a single contributor or a multiple contributor to such funds. Third is these rehabilitation funds should be either recognized as either a specific entity, a separate entity, or a asset which is totally different from all the other assets of the organization. Fourth is, as a contributor, when I am making some contribution for these rehabilitation funds, I am also I am also entitled to certain reimbursement of amounts from these funds when I'm actually going to incur the decommissioning liabilities. And my as a contributor, I should have very restricted access to these funds. So these are certain. This appendix actually deals with suppose I am making a contribution to a decommissioning or a rehabilitation funds. How should I account for my interest in those funds in my books? So this is what the appendix actually talks about. Accounting for interest in accounting for the company's interest in such a rehabilitation funds. I have a brief, one or two slides on this. Now, decommissioning funds are created to fund some or all costs of decommissioning plant or certain equipment or in undertaking environmental rehabilitations. Contributions to these funds may be voluntary or required by regulation or law. The funds established either by a single contributor to fund its own decommissioning obligations, or it may be funded by multiple contributors to fund their individual or joint decommissioning obligations. In case of multiple or joint contributions, the contributors are entitled to reimbursements for decommissioning expenses to the extent of their contributions, plus any actual earnings on those contributions, less their share of cost of administering the funds. The contributors may have restricted access to or no access to any surplus of the assets of the funds over those used to meet the decommissioning cost. So this is the a small background of what this appendix talks about. Though this appendix has got number of pages, I have just picked up the number important event item for this. The application of the appendix is, the appendix applies to accounting in the financial statements of the contributors for its interest in the decommissioning funds. The main conditions or appendix A should be applied only when these two following conditions are available: the assets or funds are held under a separate entity or as segregated assets within another entity, and contributors right to access of funds is restricted. So this is the brief premise of the appendix A, which deals with setting up of a decommissioning funds. Now, how do you are accounting financial statements in the books of the contributor? The obligation to pay decommissioning cost in accordance with the standard, that is IndAS 37, where the time value of money is material, the liability to be measured at its fair value. So just friends, just to recapitulate, I had explained about the decommissioning cost, which is expected to be incurred, say, certain number of years after the commissioning of the plant and machinery. So in that case, we need to uh, create the liability in the books at its present value, or it is measured at its present value. Contribution to the fund. How does it is accounted for in the books of the contributor? If the contributor has control, joint control significant over the fund, it will be accounted in accordance with IndAS 28 or IndAS 110 or IndAS 111. That is accounting for investments in associates and joint ventures, then consolidated financial statements, accounting for subsidiaries. So this is how you will be able to account for that interest in the fund. If no such control or significant inflow exists, then it will be in accordance with IndAS 109 as an investment or interest in the fund. But however, since I always mentioned that IndAS talks about fair value, so this amounts in accordance with 109 also has to be at fair value. Right to reimbursement from the fund for decommissioning costs incurred, measured at the lower of amount of decommissioning obligations or recognized, and contributor's share of the fair value of assets of the fund attributable to the contributor. Changes in the carrying value of the right to receive reimbursement shall be recognized in the profit and loss in which these changes occur. Now this example, matlab, this talks about how to measure a reimbursement for meeting the decommissioning cost. So this is the parameter which in the basis which you need to measure the reimbursements. Then obligation to make additional contribution to the fund. How will it be accounted? Now this may happen either due to the bankruptcy of the other contributor or decrease in the value of investment made to the fund to an extent that they are insufficient to fulfill the fund's reimbursement obligations. So in case of multiple contributors, one of the contributors or the other contributor may be required to make additional contribution. In that case, how do you measure the amount of contribution which you are liable to, which are required to make? If it is only a contingent liability, matlab where outflow of resources is not probable, then account it as a disclose it as a contingent liability in accordance with IndAS 37. If the additional contributions leads to outflow of resources which will be probable, then recognize it as a liability of the additional contribution that will be required to be made. So this is, friend, the brief, brief summarized version of the appendix. So just to recap, what does the appendix say? The appendix A talks about accounting for interest in the books of the contributor to the rehabilitation funds. Second, the contributor, either can be a single contributor or they can be a multiple contributor. Three, the contributor is also entitled to a reimbursement from the fund for his meeting the decommissioning expenses. Fourth, the appendix also lays down certain parameters of reimbursement, how the reimbursement should be calculated. And lastly, the appendix also talks about where in case of multiple contributors, if one of the contributors becomes insolvent or if the other contributors are required to make additional contributions to the fund, then how it should be accounted. If the outflow of resources for the additional contribution is not probable, disclose it as a liability, contingent liability. If the outflow resources is probable, recognize a liability or a provision in accordance with IndAS 37. So this is the broad guidelines of the Appendix A. Now there is one more appendix, friend, which is Appendix C and deals with levies actually. Actually, friend, this levy is actually we have already covered when we discussed, provisions and contingent liabilities. But since this is given as a separate appendix, I thought I will just take a one or two sliders on this so that we can just brush through these particular slides. Now, Appendix C, levies. For the purpose of this appendix, levy is an outflow of resources embodying economic benefits that is imposed by government on entities in accordance with law and or other regulations. So friends, we just looked at a case study where a company was into the business of setting up of or producing chemical plants or producing chemicals, and it had to pay up certain cleanup cost or damages for the environmental or destructions, or this is penalties. This is relating to that actually. So where such a thing exists, it is covered under levies. Levy does not cover what? Income taxes. It's a statutory requirement, so it is not covered under levy. Fines or penalties that are imposed for breaches of legislation. So fines or penalties imposed for breach of legislation is not a levy. What do you mean by this? Where you are supposed to pay income tax and you are not paid income tax. So you pay fine or additional penalties. So this is not covered in definition of levy. Clear about this? So levy means specifically imposed by means of a regulation by the government for certain on certain entities. So that is a levy. Scope is, what the scope of the appendix is: accounting for a liability to pay a levy. Appendix does not address accounting for costs that arise from recognizing a liability to pay a levy. What does this mean? So costs which are recognized for imposing a levy are not levies. Okay. Some other aspects, let us go to. Friend, these are all, very small technical things. So just that is the reason I have just taken up. We already covered in the form of examples previously. But since this is part of the standard, I just thought, I will just brush up through this particular appendix so that, we are aware that when we study India 37, we also have these two appendix which are part of the study material actually. Now, what is the obligating event giving rise to the payment of levy? The obligating event is the activity that triggers payment of levy as identified by the legislation. Now, for example, if a liability to pay levy is triggered by generation of revenue in the current period, but the calculation of levy is based on the revenue that was based in the previous period. The obligating event for the levy is generation of revenue in the current period, and obligating event is not the event of revenue which is generated in the previous period. Correct? So, in the current period, if I have generated no revenues, okay, there is no obligating event for me to recognize the amount of levy. Next, what is the where the obligating event occurs over a period of time? The revenue is recognized over a period of time based on the revenue generated. The liability to pay levy is recognized progressively and recognized as the entity generates revenue. Similarly, if the liability to pay levy is triggered when a minimum threshold is reached, such as sales, revenue, etc., the corresponding liability is recognized when the minimum activity threshold is reached. Third point, levy that will be triggered by operating in a future period is not a liability to be recognized in the current period. So this is an example of future operating losses or future costs should not be recognized as a provision. Recognized as an asset where the entity has paid an amount of levy but does not have a present obligation to pay that levy. So these are some of the pointers which are related to the levy. Now, friends, with this particular thing, what we have reached is we have actually completed all the aspects which are covered in IndAS 37. We have covered what is an obligating event. We have covered what do you mean by liability. We have covered what is a provision. We have covered what is the difference between a liability and a provision. We have covered in case of provision how to measure a provision, when to recognize a provision, what is the accounting treatment should be given for future operating losses, what is the accounting treatment to be given in case there are any reimbursements, what is the accounting treatment in case there are there are any penalties or levies to be imposed, and we have understood what do you mean by contingent liability, what is the difference between a contingent liability and a provision, what are the parameters where it differs, and we have also understood what do you mean by a contingent asset, whether or not we should recognize a contingent aspect. And so this all these discussions and all these studies actually brings us to the close of these IndAS 37, at least the technical aspects. So what I've done here, I have just summarized for easy understanding of all the of fellow colleagues now. So what does this chart says? First, we need to have obligating event. That number one. So on balance sheet date, we need to first understand whether we have an obligating event. An obligating event means a past event, a present obligation based on a past event. That is the obligating event. So whether there is a present obligation based on a past event, if the answer is yes, go to the second question. Whether its settlement is expected to result in outflow resources, answer is yes. Whether the amount of settlement and timing of settlement is certain, answer is yes. Recognize a liability. If it is uncertain, no, recognize a provision. No, whether there is a present obligation, answer is no. Then you look into other aspects. Whether there is a possible obligation based on a past event occurrence not within the control of the entity, or whether there is a present obligation based on a past event and either outflow resources not probable or amount of liability cannot be measured reliably, then in that case disclose a contingent liability. However, as I already mentioned, if the outflow resources is very remote, it is not probable, then no disclosure of a contingent liability is also required. So this is the brief summary of the entire topics we have covered under IndAS 37. Clear, friends? I hope this is quite you have understood what we are trying to do it here. Let us take just a break for 3 minutes if you all don't mind, and then we will take up more case studies. Clear? Okay, friends. Yeah, Vijay bhai, we'll take a break for
Yeah,
5 minutes.
no problem, sir. No problem.
Vijay bhai, now my study will be there for maybe around 15 minutes more. I
You
believe.
know, I believe you have some case studies after this also in
Yes,
this.
after I'm taking up a case study.
Yeah, then that will be that other
Yeah.
112.
112, sir, I will not be touching on 112 because it's only a theory, sir, actually. So,
Yeah, but at least some reference you can give.
ठीक है. I'll just go through the slides. Thank you. राकेश जी कैसे हैं?
Yeah, so you can start.
Yeah. Yes, friend, welcome back. We will start the case studies now. Now, this case study is related to measurement of provisions. X Limited sells digital cameras with a warranty under which customers are covered for the cost of repairs or manufacturing defects within the first 12 months after purchase. X Limited has estimated if every product required minor repairs, the cost would be rupees 2 lakhs. If the product was replaced, the cost would be rupees 5 lakh. X's past experiences and futures expectation indicate that 75% of all goods will be sold will have no defects, 15% to have minor defects, and 10% will need a replacing. Calculate the amount of provision. Friends, this is as we have discussed. There is these are all as we have discussed earlier, friends. There are two methods to the measurement of provisions. One is the expected value method. Expected value method deals with where there are multiple outcomes and there are attached probabilities to each outcome, and the most likely outcome method where there is the outcome is only one, but there are the liabilities amounts may differ based on the other parameter which are attached to the outcomes. So this example is based on the expected value method, where the estimate of provision is equal to sum of outcome probability multiplied by the estimated cost for that outcome. So the provision amount will come to say rupees 80,000. So this is an example on the based on the expected value method. Second example is based on the most likely outcome method. X Limited has a court case pending against it as on December 31, 2006. X lawyers estimated that there is a 40% chance of X Limited incurring liability of 1,50,000 rupees, and there's a 60% chance of X Limited incurring a liability of 1,20,000. Calculate the amount of provision. The case is based on most likely outcome method. Therefore, the estimate of provision is equal to outcome with the highest probability. Provision is rupees 1,20,000, having the highest probability. So these are two examples which we have already just to refresh. We have taken the example. So outcome method, जैसा कैसा है, most likely outcome is there is only one outcome. Okay, and we can either go for the lower probability or the higher probability. So it is depending on which amount we are going to choose, but we can always justify the amount which we have chosen. So outcome is only one. Let us go to next case study. Friends, here I will give you all 5 seconds to think over. Case the first one. Which of the following statements best describe the liability, term liability? A future obligation where settlement is probable, resources to meet financial commitment as they fall, residual interest in the assets of the entity after deleting all its liabilities, present obligations of the entity arising from past events. Clear about the answer? Next, a provision is estimation of expenses to be incurred in the future, a possible obligation based on a past event, a liability of uncertain timing and amount, estimation of expenses which cannot be reliably measured. Provision to be recognized only when there is a past obligation, present obligation, future obligation, and possible obligation. So answer is B. Next, which of the following is within the scope of IndAS 37? Provision for bad debts, provision for taxes, future payments under a contract where contract cost to complete the contract is more than the contract price, and future payments for smoke filters required by law. So the answer is C. Provision is measured and recognized at amounts which is the highest amount required to settle the liability, which is the lowest amount required to settle the liability, which is the best estimate of amount required to settle the liability, which is the exact amount required to settle the liability. So most of you people have got it right. Answer is C. Next. A contingent liability is recognized in the financial statements, recognized in the financial statement if the outflow resource is probable, never recognized or disclosed in the financial statements, disclosed in the financial statement if the outflow resources to settle the obligation is not probable. बहुतों का सही जवाब. Good. Provision for restructuring cost is recognized when the restructuring cost is approved by the management, restructuring costs are incurred, the restructuring progress is in the process of implementation and communicated to those affected by the restructuring only when the entire restructuring process is completed. Excellent participation. I'm really happy that people have understood the standards. Very good. So the correct answer is C. A contingent asset is always recognized in the financial statements, never recognized in the financial statements, sometimes recognized in the financial statements if best estimate of income can be made, disclosed in the financial statement if the outflow resource is probable. My friend, has this created some confusion? This question. I am not receiving chats from anybody. Only one.
Lot many replies are there between B and D.
Correct. I will agree with that. Both B and D are correct actually. Though I mentioned here D, both B is also correct. Okay. Disclosure, I don't want to go into disclosures now. Let us look into the gap differences now. What are the key differences between IndAS and AS 29? Provision in case of AS 29 is a liability which can be measured only by using a substantial degree of estimation. IndAS has a different definition. It is a liability of uncertain timing and amount. Time value of money for measuring the provision. The amount of provision in case of AS 29 should never be discounted to its present value except in case of decommissioning liabilities in PP AS 10, where the time value of money is material, provision should be at its present value in case of IndAS 37. Recognition criteria for provision. Entity has a present obligation as a result of past event. No mention of constructive obligation in AS 29. In case of IndAS 37, entity has a present obligation legal as well as constructive as a result of past events. Application to financial instruments. AS 29 does not apply to financial instruments that are carried at fair value. IndAS 37 does not apply to financial instruments including guarantees that are within the scope of IndAS 109. Measurement of provisions. Standard says best estimate on management judgment and in some cases reports from independent experts. IndAS does not allow this type of a measurement. It says actually maybe you can rely on independent expert, but you have to have some method like the expected value method or the outcome method for measuring the best estimate of provisions. Accounting for levies, again there is no specific guidance in AS 29. In case of IndAS 37, there is specific guidance given in the form of Appendix C. Accounting for decommissioning funds in the financial of contributors, no specific guidance, but specific guidance is given in the form of Appendix A in IndAS 37. So friends, with this we come to the total conclusion of IndAS 37, provisions, contingent liabilities and contingent aspects. As you all must be now aware that there are certain very critical technical points before we recognize any liability, before we recognize any provisions, or before we disclose contingent liabilities. When should we convert disclosure of a contingent liability into recognition of provisions? So all these things we have looked into in this topic. So with this, I conclude IndAS 37 and we move for a very brief period to IndAS 12, which is actually nothing but a disclosure standard. So I have friends, I have 4 or 5 sliders on this particular topic. There is absolutely nothing technical about IndAS 1112, but since it is part of our program, so let us brush up through these particular slides. It is a 5 to 6 sliders only. Okay. Just Just 1 minute, sir.
You may have to alt tab to start it.
It's not visible, sir.
नहीं, the folder is visible. Alt tab करना पड़ेगा.
अच्छा अच्छा.
Otherwise, I will connect it from here if there is a problem.
ये हो गया?
हाँ, अभी आया.
Okay. Friends, let us briefly touch upon this IndAS 1112, which is disclosure of interest in other entities. And this is a disclosure standard, and as I mentioned, it does not have any much technical, it does not have much technical things where we need to have more attention to that. Now I'll just brushly, there is a 5 to 6 sliders which I will just go through the slides, and that is all for this particular standard actually. So what does the standards applies to? The standard applies to entity that has an interest in a subsidiary, a joint arrangement, that is a joint operation or a joint venture, an associate or an unconsolidated structured entity. The objective of the standard is to enable users of the financial information to evaluate the nature of and risk associated with its interest in other entities and the effects of those interests on its financial positions, performance, and cash flows. An entity shall disclose information about significant events, judgments, and assumptions, like that it has control over an entity that is an investee, that is a joint control of an arrangement or significant over another entity, and the type of joint arrangement where the arrangement has been structured to a separate entity. So this is what the standard actually applies to, where as an entity, if I have interest in any subsidiary joint venture, or I have interest in in an associate company or an unconsolidated structured entity, then how do I disclose my interest in those entities so as to enable the users of financial information to evaluate the risk and associated with such investments? Now, when we talk of disclosure of interest in subsidiaries, the entity shall disclose information that enables the users of its consolidated financial statements, A, to understand the composition of the group and the interest that non-controlling interests have in the group's activities and cash flows. B, to evaluate the nature and extent of significant restrictions on its ability to access or use or use assess liabilities of the group, the nature of and changes in the risk associated with its interest in consolidated entities, the consequences of changes to its ownership interest in a subsidiary that does not result in loss of control, consequence of losing control of a subsidiary during the reporting period. Sir, just 1 second, 1 second, sir. For each subsidiary, the entities are also disclosed details about non-controlling interest, which includes proportion of voting rights held in non-controlling interest, profit or loss allocated to the non-controlling interest during the reporting period, accumulated non-controlling interest of the subsidiary at the end of the reporting period. So this is dealing with, in disclosure of interest in subsidiaries. Then disclosure of interest by an investment entity and its unconsolidated subsidiaries. Friends, I hope we have all done consolidation 110, right? Where we have understood what do you mean by investment entity. So this talks about disclosure of an investment entity. An investment entity shall disclose information about significant judgments and assumptions it made in determining the investment entity. When an entity becomes or ceases to be an investment entity, it shall disclose The changes and reasons for the change, including the effects on the financial statements in the period of change, including total fair value as of the date of change of subsidy that ceases to be consolidated, total gain or loss, if any, and line items in profit or loss in which the gain or loss is recognized. And information about unconsolidated entities. The disclosure shall be the name and principal place of business of each unconsolidated subsidiary, proportion of voting rights held in each unconsolidated subsidiary, nature extent of any significant financial restrictions, if any, on the ability of the unconsolidated subsidiary to transfer funds, which dividends, repayment of loans, etc., to the investment entity, current and other financial commitments to the unconsolidated subsidiaries. Friends, as I mentioned, there is absolutely nothing technical about this. So this is a pure disclosure standards. And most of the disclosures are also, they are also given in the disclosure paragraph of those specific standards also. Then in case of joint venture associates, the entity, nature and extent of the financial effects of in joint arrangement in associates, including the nature and effects of its contractual relationship with other investors with joint control of or significant influence over the joint arrangement and associates, and nature of and changes in the risk associated with its interest in joint ventures and associates. Interest in unconsolidated structure entities. The entity shall disclose nature and extent of its interest in unconsolidated structure entities and nature of and changes in the risk associated with its interest in unconsolidated structure entities. So friends, this is bringing to the end of the discussions of IndAS 112. Now, the most important thing which I want to mention over here, friends. See, disclosures, IndAS disclosures as well as the AS disclosures. There is a huge significant rise or increase in the disclosures required in IndAS. When you compare any AS balance sheet with an IndAS balance sheet, you will appreciate that the figures, balance sheet, profit and loss account, and cash flows, they hardly consist of 5 to 6 pages. 98% of the financials annual reports consist of disclosures. So this is how paramount importance disclosures are to the IndAS financial statements. So with this, friends, I feel that this is the end of the session for the day. Though there is nothing much to discuss about IndAS 1112, I thought that at least I will bring out the slides and the main aspects, main disclosure which are required for this type of investments. So back to Vijay Bhai. Thank you for everything.
So there is one
Hello.
query. Yeah, Manilal bhai, please take over.
Hello, Bhaskar ji. There is one query
Yeah.
regarding a doubt regarding the previous AS. What is the logic behind bank guarantee being a contingent liability?
Sir, in IndAS, bank guarantees, sir, when you do financial instruments, okay, financial instrument जब भी आप करेंगे, financial instrument talks about recognizing bank guarantee as financial guarantee obligations in the books of accounts. In case of AS, where we prepare the financial statement under the Indian GAAP, it is disclosed as a contingent liability because there is no possible, because it is only a possible obligation of outflow of resources. There is no present obligation on balance sheet date. So that is the reason we disclose as a contingent liability for bank guarantees, because it is only a possible obligation. Whereas in case of IndAS, in case of a company, a corporate, a parent giving guarantee on behalf of its subsidiaries, the parent and subsidiary will have to recognize the financial guarantee obligation in the books at fair value. So this will be taken up when the person who is doing IndAS 109, he will discuss about this in length actually.
Sir, there is one more query.
Yeah.
Variable payments made to the terminated employee.
Okay. So I'm not able to hear.
It is variable payment made to the terminated employee will be RC if we have already created a provision in the normal course of business.
Okay.
And the variable payment is the performance bonus. This doubt is with regard to the restructuring cost.
Okay. Sir, again, when you are making payments purely on account of restructuring, matlab you are terminating employees, okay? So all these, payment which are compensation which you are giving for retrenchment or for removing the staff, this will be part of restructuring cost.
Thank you, sir. Manilal bhai, are you there? I think his video is off. Manilal ji, your net connection is not clear.
I'm here only.
Yeah, so please proceed.
Net connection. Sir, now it is all right?
Yeah,
Yeah, we can hear clearly, sir.
Bhaskar bhai explained many things in detail regarding provisions and liabilities. There is a fine line difference between provisions and liabilities, and that has been cleared with in great detail. He has taken many case studies and tried to explain everything in detail. He has also explained the contingent liabilities and assets concept in detail and what are the accounting entries and sensitivity. I hope every participant have gained a lot of knowledge on today Teachers Day from the learned speaker Sri Bhaskar Iyer. I request you to carry a large upload in technical terms for our today's speaker Bhaskar ji, please.
Thank
Over
you
to
very much.
Vijay bhai,
Thank
sir.
you, everyone. Thank you, Rakesh ji. Thank you, Vijay bhai. Thank you, Manila bhai. Thanks, everybody, for giving me an opportunity to be a part of this wonderful session. Thanks a lot, sir. Thanks a lot.
thank you, sir. Thank you, Manilal ji, for conducting the beautiful session in spite of technical issues at your end. Bhaskar ji, thank you for accepting our request and guiding our delegates on a beautiful session. Friends, tomorrow 11 o'clock we'll be meeting for IndAS 116. So kindly log in. All those who are on Zoom should log in by 10:45. YouTube will start at 11 o'clock sharp.